Welcome! In this video, I will give an overview of credit risk rating and go through steps of developing and utilizing a risk rating system. Let's start with why we risk rate loans. A credit risk rating system allows lender to manage risk at both the loan and the overall portfolio level. And it provides a common language for describing credit risk exposure within an organization. A well-managed risk rating system also gives the board of directors, auditors, and regulators information they can use to assess the overall health of the commercial portfolio, as well as the effectiveness of credit risk management. According to NCUA, the regulator for federal credit unions, the goal of a risk rating system is to identify, measure, monitor, and control risk. And it is used during the whole loan cycle, from underwriting during loan origination to monitoring and risk mitigation during portfolio management, as well as the financial management of the organization as a whole. Now let's look at how risk rating system achieves these goals and helps with risk management. The answer is by standardizing, quantifying, and categorizing risk. First, it standardizes risk assessment so we can identify the strengths and weaknesses of the deals consistently during underwriting and monitoring. When risk is measured in a standard format, it can help collect data to validate or determine new factors that lead to default. This information can be provided as feedback to underwriting so we can make better decisions at loan origination. Also, it can be used as a training tool for loan officers and analysts that summarizes the factors to evaluate consistently when analyzing risk. Second, it quantifies the risk so we can measure it. It can help us estimate probability of default, which in turn helps us estimate losses that could be the basis for loan loss reserves. Third, credit risk rating systems categorize loans based on their risk. Different action steps can be determined depending on risk category, such as identifying problem loans that require more focus during monitoring could trigger proactive reach out to the borrower. Now let's talk about developing a risk rating system. There is no single credit risk rating system that is perfect and best for all. Because there is not a standard credit risk rating model, each institution should customize a system to fit its unique needs. When developing a system, the things to consider are methodology, process, and evaluation. While we're determining the methodology, we need to think about the scale and the meaning, the criteria, and the scoring model. The scope and scale of a credit risk rating system will depend on the diversity and the complexity of the commercial loan portfolio. The criteria used to assess risk could depend on general credit risk criteria as well as sector-based indicators. The scoring system would typically incorporate quantitative and qualitative factors. In terms of process, we should consider when risk rating will be performed and how frequently, for which loans it would be applied, all loans or a subset of loans, who will perform the risk rating, and how it will be used and reported on. Lastly, we should think about how to evaluate the risk rating system to assess its effectiveness and allow for refinement over time. Now let's talk about methodology in more detail. A good place to start thinking about methodology is regulatory guidelines. According to NCUA and OCC, there are 5 main categories for risk: pass, special mention, substandard, doubtful, and loss. Loans in the pass category do not have significant weaknesses. A special mention asset has potential weaknesses that require close attention. Examples are declining revenue, tight liquidity, adverse market economic conditions, or a management problem. A substandard asset has a well-defined weakness or weaknesses that jeopardize the liquidation of the debt. Examples include being unprofitable, inadequate debt service coverage ratio, or inadequate liquidity. When the risk of default is realized, loans are classified as doubtful. Because of high probability of loss, non-accrual accounting treatment is required for doubtful assets for regulated entities. Assets classified loss are perceived to not have any chance to be a performing loan again, and liquidation of collateral starts. The number of ratings in a credit risk rating system depends on the complexity of the loan portfolio and the institution's risk rating system objectives. Most rating systems have between 6 and 10 ratings. Usually pass and special mention categories can be subdivided further. Once you decide on how many categories you have and their meanings, next you would need to think about which criteria to evaluate. These would be typical criteria used during underwriting. The first one is capacity to repay, which is whether the business can generate sufficient cash flow to cover expenses and repay the loan. The second is character. It's the willingness to pay in addition to ability to pay. Management needs to have the education, industry knowledge, and experience to successfully operate the business and manage employees. The third one is capital, the personal equity put into the business. The more equity put in, the lower debt payments are, which strengthens the credit and reflects more skin in the game. And number 4 is condition, which is the environment the business operates in, the industry, the market, and the economy. Collateral is the last criteria lenders assess, which is the business or the business owner's assets as a secondary source of repayment. You may or may not include this criteria in your risk rating model, depending on how you will use it. I will exclude this in my further modeling examples, as I assume that risk rating will be used to calculate probability of default, and collateral will affect loss severity, both of which combined together determine expected losses. The other piece to incorporate into risk rating is loan performance, including distress modifications, delinquency, and/or charge-off. These help categorize higher risk ratings. Once you have your criteria down, you need a system to score each criteria and come up with an overall score. For each of the criteria we discuss, you need a measure. That is step 1. For example, for capacity to repay, you can use debt service coverage ratio as a measure, and maybe some balance sheet ratios. For character or management, you can use length of experience and credit score of owners. For capital, you can use equity as a percent of the project you're financing. For conditions, you can use industry or market statistics. Step 2 is think about which factors are more important than others and assign weights to each criteria accordingly. Step 3 is a scoring guide that provides a range of values for each measure. After each criteria is scored, a weighted average score is calculated incorporating the weights for each criteria. Finally, as step 5, the weighted average score is converted into a rating. This is a basic rating matrix incorporating regular credit risk underwriting criteria. It can be customized based on key sectors. For example, for charter schools, academic performance is very important. For commercial real estate, you might want to incorporate occupancy rates. For faith-based organizations, you could think about incorporating givings per unit. Or for childcare businesses, the subsidy percentage is important. As a final note, creating a rating matrix is art as much as science. It combines both quantitative and qualitative factors. Now let's look at an example. In this example, rating matrix and loan performance are used to create 7 categories. Pass and special mention are subdivided into 2. And one is pass with 1 plus and 1 minus as subcategories. 2 is special mention with 2 plus and 2 minus as subcategories. 3 is substandard, 4 is doubtful, and 5 is loss. The matrix determines ratings from 1 to 3, and negative loan performance affect ratings from 3 to 5. This is the business risk rating matrix used at Self-Help. This matrix shows the criteria, measure, weights, and scoring thresholds. We also have specific rating matrices for commercial real estate, charter school, hotel, and faith-based sectors. The way we came up with these matrices is, after discussions with commercial lending staff, we identified the factors that we collectively believed that affected loan performance and supplemented some of these criteria, such as credit score, with statistical analysis. We tweak things over time as things change or we know more. As I mentioned before, each commercial loan portfolio and lending institution is unique, and the rating matrix should be customized to fit your culture, processes, and risk profile. You don't want to overcomplicate or oversimplify the model and find that right balance for your organization. Once you have the rating model, you should consider the process. First, you need to determine when risk ratings will be performed and how frequently they should be updated during monitoring. Credit risk rating system should be dynamic, and ratings should change when the risk changes. Ideally, deteriorating trends should be detected and acted on early to improve the likelihood of repayment. Next, you need to think about for which loans it would be applied. All loans or a subset of loans? Should it be at loan level or associated borrower level? Third, you would need to think about who will perform and approve the risk rating during the loan cycle. Is it loan officer, analyst, risk management, credit committee, or a special committee? And then lastly, you need to determine how it will be used, documented, and reported on. Potential uses other than underwriting and monitoring are risk-based pricing, loan loss reserve modeling, and stress testing. In terms of documentation, the loan size and risk should be balanced with the depth of the report. For smaller and lower risk loans, the matrix itself can be used for documentation. And for larger and more complex loans, a full narrative report that tells the story behind the scores would be needed. In terms of reporting, in addition to loan level reports, portfolio level reports such as rating distribution by sector and risk migration trends can be provided to the board, the management, the finance team, and also external parties such as examiners, auditors, funders, and credit enhancers. Once you determine your processes, you should make sure they are documented well as policies and procedures. Now the last part, evaluation. Rating systems should be evaluated and refined on an ongoing basis to ensure a couple of things. First, the rating matrices should capture the credit risk of different deals and make intuitive sense. Second, credit weaknesses should be identified promptly so that timely action can be taken to minimize credit losses. And third, loan loss reserves should be adequate with the credit risk of the portfolio. The evaluation can be qualitative or quantitative, such as monitoring historical incidence of default by risk rating to see if risk ratings have been predictive of default. In addition to internal assessment, evaluations by auditors and examiners provide good feedback about whether credit risk rating systems are adequate. This concludes the risk rating video, and I hope it was useful. Goodbye until the next video.